You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you're doing well on this Tuesday. I'm probably on the road as you are listening this, touring the island with a small motorhome. Super exciting moments. I can't wait to tell you more about it when I come back. And today we are going to talk about some transportation business, TFI International. Funny enough, this is a big home run that we had at DSR. I highlighted this stock in 2016, showing that business to my members, telling them about how great this growth by acquisition trucking company in a boring industry has been able to unlock so much value for shareholders. And today we're going to take a look at it. We're going to use the same investment analysis framework. So we're going to talk about the business model. We're going to talk about the narrative and the growth potential. We're going to look at the numbers, and then we're going to end up with the risk section, which is, we end up with the risk, but seriously, like my trick here is always to do the full analysis, leave it on my desk, and then come back a day or two after the hype, and then look for problems, look for risk, and think about what could really happen in the worst possible type of ways, because this is when you know that you know the business inside out. So speaking of knowing the business inside out, let's get started. So TFI International, TFII.to or TFII on the US market. So since they generate 68% of their revenue coming from the United States, after multiple acquisitions, they decided to pay their dividend in USD and also trade on both markets, which kind of makes sense, right? Because now it's like 2/3 of their business coming from the United States. So how they're making their money? Well, they have most of their revenue is coming from what they call less than truckload transportation. So that's 43% of their revenue for Q1 of 2024. Less than truckload, what it is, well, I have some goods I need to transport, but it's not big enough to have a full truckload. So TFI International, they're such good guys. They're going to do it for me, but of course they're going to charge me a premium because I have to pay a little bit more than if I had a full truckload. And what they do is they will combine more than one delivery, more transportation to make it more profitable on their end. So less than truckload, 43%. Full truckload is 25% of their business. Another 25% is logistics. So they are helping their clients to move goods from A to Z, optimizing transportation routes, offering services, offering all the literally the infrastructure and logistic to do same day delivery as well. So this is all the services they provide with logistics, and they have a small portion of their revenue coming from package and courier. So that's only 7%. Definitely not their core business. So their core business is all about less than truckload and truckload plus the logistics, and this is how they are making their money. Now, what's the investment thesis here? Well, the first part of the investment thesis is this company is a serial growth by acquisition business. They made 87 acquisitions since 2015. So they keep on buying trucking companies, integrate them. They definitely have a very solid playbook to do that. And what's interesting here is as they grow, they find better opportunities, and then when there's a recession or like when clients are when their competitors are struggling, what they do is they make even more acquisition because they have this ability to do it. So the more you get big, the bigger you are, the easiest it is to buy smaller trucking companies, and they operate in a highly fragmented market, make it very easy. The other advantage from that strategy in this specific type of business is the more you have routes and station of operation across North America, well, the more synergy you can do, and then it's easier for you to offer less than truckload at a good price and optimize it into pretty much truckload on your end and improve your margin because you have a lot of trucks on the road, you're covering a lot of ground, your network is going across North America. So it makes it a lot easier for them to compete against anybody else because they have that coverage, they have that economy of scale, and the more they buy competitors, well, the more they increase those competitive advantages. So it's kind of like a flywheel that keeps on growing and generates a lot more cash flow than their competitors. So the bigger you get, the more business you get, and the more profitable you become. So that's pretty much how they built their business. And when you now look at the numbers, so let's take a look at the dividend triangle. Well, you will see that the company has been growing steadily between 2015 and 2021. So it was like good constant growth, but then there was a huge moment in 2021 when they acquired UPS Freight, and now the revenue surged from like roughly 4 billion to almost 9 billion. So they kind of like doubled the business. The earnings almost followed equally, which is great because it shows that they are able to maintain very strong margin. And you can guess that, of course, the dividend kept on increasing. So long story short, over the past 5 years, the revenue growth is double digit, the earnings per share growth is double digit, and the dividend growth is double digit. I'm going to take a quick pause here before I go to the risk. But if you want to find those kind of businesses with double digit revenue, earnings, and dividend growth, I have created the Rockstar list giving you exactly those numbers so you can filter and navigate through this Excel list where I've put all the Canadian and US stocks showing a positive dividend triangle. And you can do one more step just to pick the one with high single digit to double digit growth for those three metrics. You're going to pick thriving companies. Of course, that's just one step. You need to dig a little bit deeper, but it's a pretty solid first step if you're looking to buy new stocks in this crazy market. So you can download it at moosemarkets.com/rockstars, moosemarkets.com/rockstars. And once you enter your email, you're going to receive an updated version of the Rockstar list every single month. So now we have looked at the business model, trucking business, growth by acquisition. We know the investment thesis is all about operating in a fragmented market where they can acquire cheap and small pieces of competitions, grow by economies of scale, benefit from their network impact, and the numbers are working. So the dividend triangle shows exactly the same thing. So now what's the risk? Because double-digit growth all across the board. The stock price, skyrocketed from like 40 something in 2019 to almost $200 as of late. What's wrong with TFI International? Well, the first thing, of course, is since they grow by acquisition, we're thinking about debt. So that could be a big thing. Before their acquisition in 2021, they had a long-term debt of $1 billion. Now they're racking that up to $2.5 billion. So, of course, the more they buy, the more it's going to be expensive. Interest charges are going to increase. So that could weigh on their long-term growth by acquisition strategy. The second thing is, while recessions are some kind of like good for them because they can buy competitors, if there's a deep recession, it will also affect them. So they will see revenue and earnings going down, which is happening right now. Since the peak of 22, they see less transportation, less volume. So earnings and revenues are slowing down for the past 2 years. And that could create some volatility around the stock because the stock price, when you look at it, it goes up, yes, but it goes up and down all the time. So in 22, it went from like $130 to 100 and then going back to 130 and then to 150 and then back to 140 and then it goes up and down like this. So be careful about this volatility. Finally, they are a victim as well of oil price. So when fuel are higher, of course, they can charge fuel as a fuel surcharge, but there's a limit of how much they can charge their client. Sometimes the clients will just decide to go with alternative transportation, such as railroads that are like less specific, but are pretty much cheaper. So as you can tell, there are some risks around TFI International, but overall it is a pretty solid business. Just have to be careful about the debt level, about their acquisition playbooks. So far it's working well, but maybe at one point it's going to be a bit different. Finally, the forward P ratio right now is at 18 times the earnings. The average over the past 5 years is at 16. So maybe it's not the perfect timing to enter a position. Depending on what's going to happen going forward, you may be paying a bit of a steep price at this level. But again, I always say you have to pay for quality. So, all right, Moose, that's enough for today. Tomorrow, we're going to talk about life insurance companies, looking at Great West, Manulife, and Sun Life. So make sure that you rate this podcast if I'm providing value. Give me a 5-star review. It means the world to me. As you can see, I'm not putting any ads or anything else on this podcast, so I kind of need your help to make it grow. So, all right, Moose, we're going to talk life insurance companies tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.